So thank you very much for staying until this part of the conference. It's a pleasure to present this new paper, brand new, with Miguel, Patricia, and Sebnem. So as we all know, COVID-19 has propagated to economies through various channels. We're motivated by two strands of literature that has looked at this propagation. On one side, you have the interesting literature on how firms have coped with this shock and the role of policies in helping firms cope with the shock. There's nice papers by several of the attendees of this conference. Another strand of literature, more macro and international finance, has looked at the role of large movements in cross-border capital flows that the pandemic brought about. However, the intersection between these two strands of literature has remained largely empty, yet several interesting questions in this overlap between the two literatures are important, are policy relevant, and we're gonna address them in this paper. For example, how firms reacted to the sudden drying out of international capital markets amid COVID. Were they able to adjust their finance mix between international debt issuance and domestic debt issuance? And what was the role of policy in this change in the finance mix of firms? So answering these questions is relevant for small open economies. Chile is a good example. On the left, you have a picture of how capital flows came to a halt at the beginning of COVID. Here we're plotting bond flows associated to EPFR data. And simultaneously, corporate risk, as captured by the SEMBI, skyrocketed, right? Simultaneously, you had central banks doing a lot of things. On your right, you see how in Chile in particular, there was a big increase in credit facilities provided by the Central Bank of Chile. I forgot to add the disclaimer that these are views. These views are our own and only ours, and do not involve the Central Bank of Chile's official stance in any way. So, given these motivating facts and questions, what is it that we do in this paper? Well, we're going to provide answers to those very same questions that I postulated earlier, using two things: data on Chilean firms and economic theory. So we have two fronts in the paper. On the empirical front, we're going to use a quite unique administrative data from Chilean firms that is going to allow us to keep track of the full spectrum of the finance mix of the universe of firms in Chile by looking at their domestic and external debt issuance. Importantly, we're going to complement this with data on the credit support policies that took place in Chile. On the theoretical front, what we're going to do is we're going to build a very simple model with heterogeneous firms that is going to aim at capturing the key channels that affected the firm's finance mix in the wake of COVID, and importantly also, what role did policies play in this finance mix? This is the one slide with the key takeaways of the paper. On the empirical front, we document a change in the finance mix of firms, with firms moving away from foreign debt and into domestic debt. Furthermore, we establish some causality in this outcome from credit policies and into the firm's decision of their finance mix. The credit policies in particular that involve issuance of public guarantees on bank loans to firms. On the model side, the model stresses the role of financial frictions in this debt substitution mechanism. And it's going to also underscore the complementarity between the two pillars of the credit support policies namely central bank liquidity provisions to commercial banks, together with the public guarantees on bank loans to firms. Let me start saying a few words about the data. We're gonna leverage on a massive effort that the Central Bank of Chile has been doing over the past years in building and maintaining a repository of anonymized administrative data set for policy and research. In this work in particular, we're gonna merge 4 administrative data sets. The first one is data on capital inflows, for which we have the universe of borrowing transactions between firms and foreign lenders in terms of bonds and loans, with richness in the information on these transactions, spreads, loan amounts, etc. We're going to couple this with the credit registry, for which provides us with the universe of domestic stock and flows of firms' bank debt. Also, some rich information associated to these transactions, rates, loan amounts, etc. And these, importantly, are going to include the loans under the credit support programs that took place amid COVID. We're going to couple that with a third data set on bond issuance, for which we have the universe of firms' bond issuance in the domestic financial market. And last but not least, we're going to couple that with the real side of firms by providing information from a production data set that contains, for again, the universe of firms, sales and expenditures. So let me say a few words about the credit support policies that took place in Chile, as probably most of you are not that well familiar with some of the details that are important for our specifications. So credit support was an essential element of the policy package that was implemented in Chile amid COVID. 2 pillars that sustained the credit support programs were, first, a novel credit line facility from the central bank to commercial banks called FSIC that provided credit to banks, commercial banks, provided that they grew their credit issuance, particularly to small and medium firms. The second pillar were the sovereign guarantees on commercial bank loans that I alluded to earlier, a program called FOGAPE COVID. This program was aimed at commercial bank loans to firms that were below a chosen predetermined level. So FOGAPE dates back several years back. It's a program that has traditionally served government in channeling resources to be used as fraction of collateral for credits taken by small firms. And eligibility for this traditional program has always been associated to firm sales. Importantly and crucially for our empirical approach, on April 25, 2020, the government launched a modification of this traditional program called FOGAPE COVID, which included a massive recapitalization of the fund that provided these public guarantees. And importantly, crucially for what we're about to do, it relaxed the cutoff required on firms for them to access these credits with sovereign guarantees. This table summarizes well the key elements of the program. On the right, you have some of the key aspects of the new FOGAPE COVID, that was launched in April 2020, and it compared to the traditional program, the FOGAPE, as it stood on January 2020. There are 2 key things that I want you to take away from this that characterize this program. First, the interest rate was capped at the monetary policy rate plus 3%, in contrast to the previous program that had a market interest rate. And even more important than that, the eligibility cutoff was raised for firms with an annual amount of sales below 1 million UF, which is an inflation indexation device used here in Chile. So all of a sudden, a large proportion of firms pass from being illegible to this program to being eligible to this program. What does the basic descriptive statistics tell us about the finance mix of firms? Well, I guess this picture captures very well some of the more refined, sophisticated results that we get later on. So let me spend a minute here. On your left, you have a picture taken in January 2020 with the debt allocation between domestic and external across firm sizes. And as you see, you have that the bigger the firms, the more they rely on external finance, foreign international finance. This is a result that has been documented elsewhere. Sebnem has some papers on that. What happens if you do the same, take the same picture for the flows that accumulated during COVID until August 2020? You see, this is what you have on your right. You see a big debt substitution with firms, again, moving away from external international debt issuance to domestic debt issuance, particularly for the large firms, which are precisely those that fall into this category that I alluded earlier, that they suddenly became eligible to this program. Now, of course, there's many things going on. This is COVID, plenty of shock policies going on. So we're going to try to identify results here or drivers of these finance peaks by using an RD, a regression discontinuity design analysis, which falls very naturally to the specificity of this program. In particular, we're gonna assess whether becoming eligible to receive these FOGAPE COVID credits change the finance mix. So did it increase or not the share of domestic debt over total debt? It's a natural setup. Changes were exogenous in sales. Firms were quasi-randomly assigned in the neighborhood of this million UF threshold. Arguably, there was no selection as eligibility had to do with sales in the past, 2019 sales. We do confirm this, however, with some statistical tests. And at the bottom of your screen, you have the very simple RD analysis that we do. We try to pin down the coefficient that maps eligibility of firm I to the debt share, domestic share debt over total debt for each firm. This is the RDD results. So on the figure, what shows is the domestic debt share, and the vertical line is the median UF threshold that I alluded. There's clearly a nonlinearity that is picked up by the RD analysis. The coefficient delta is significant through various specifications that we run that vary in terms of the type of polynomial that we use to fit the data that you're observing. It is significant at 5 and 10% throughout the specification. And in economic terms, what it says is that eligibility increased the domestic debt share between 9 to 14%. This is not only statistically significant, but it has some important macro implications because the firms that became eligible are big firms, are firms that account for 18% of GDP, and their increase in the domestic credit was about 1% of GDP. Let me try to flesh out the key elements that we're gonna have in the setup, the theoretical model that we're gonna have. We're gonna try to keep it as simple as possible, but focusing on the key elements that we want to model and to understand in these empirical results. So the model is going to have 5 distinctive characteristics. We're obviously going to want a framework where this finance mix between domestic and foreign debt is endogenous. So we want to say something about this within the model. Importantly, we also want we want the model to tell us something about the heterogeneity across this finance mix. And we're going to resort to that, to financial frictions that are also going to be motivated by, for instance, this evidence of bigger firms having more access to external international debt. There's further evidence that we collect in the paper, let me click on this, that also points to bigger firms being more leveraged, something that Sebnem, Gita, Carolina, and others have documented elsewhere. This is also true in the data for Chile. So we want financial frictions to help us account for these facts. Which financial frictions, I'm going to be specific in a second. Importantly, also, we want the model to capture a wedge between domestic and international interest rates, captured by this inequality. And this is also motivated by the evidence we see in the Chilean data, where we find roughly historically, pre-COVID, a differential of some 300 basis points between domestic rates and international rates, so rates at which Chilean firms can borrow abroad. So this is going to drive firms to want to issue debt in international market because it is cheap. Fourth, we want also some risk aversion in the model that impacts the credit supply. We're going to model this in a very minimalistic way, but we also want to keep this flavor in the model, whereby risk aversion spiked by COVID affects credit supply. And last but not least, obviously, we want this setup to be perturbed by what we call an international COVID shock to credit markets worldwide. We're also going to be using this setup to think about policies, credit support policies, akin to the FCIC and FOGAPE COVID that I mentioned earlier. Okay, so what's the very simple environment that we're going to work with? We're going to have a model of 2 periods. It's going to be a small open economy. It's going to be a real model. So importantly, we're going to abstract, at least in this version of the paper, from any exchange rate risk. There's going to be a single good. The key player in this model is going to be firms, of course, and we're going to allow for heterogeneity across these firms. We're going to have identical households. Government are going to implement the policies. We're going to have foreign lenders and a very, very minimalistic bank, commercial bank. What happens in period 1? Households get an endowment and they eventually deposit in banks. Firms type are going to be revealed, and I'll say much more about this later on. The type is going to be revealed through the amount of international collateral that they're going to get. They're going to borrow abroad and domestically, and with that, they're going to invest in capital that is going to be used in period 2 to produce the only good in the economy. Firms are going to repay both debts, and firms and households are going to consume. So what are the type of financial frictions that we're going to be working with? We're going to be using Caballero Krishnamurti, well-known role for international collateral. So firms in this model are going to get an endowment of international collateral. We're going to deviate from Caballero Krishnamurti in that they're going to be heterogeneous in the amount of collateral that they're going to get. This lambda I F for foreign, which is going to be uniformly distributed in a support between 0 and lambda bar. So there will be 2 collateral, to be precise. One constraint that alludes to foreign debt issuance that basically postulates that you can borrow up to your amount of collateral, international collateral. And then a domestic collateral constraint that is going to postulate that your debt needs to be lower, equal than or lower than a fraction theta d of your income, plus whatever remaining collateral, international collateral you're left with after you issue debt. Firms are going to have a very standard technology to produce goods that is going to take a capital only, And capital is basically going to be equal to whatever debt domestically or foreign the firms issued in the previous period. Importantly, for all firms are identical in terms of their technology, right? So they will all want to achieve what is the optimal amount of capital, K star here, and they're gonna want to issue debt to achieve this K star level. Now, we're going to make some assumptions in the extreme of the support of lambda, so that there is borrowing in equilibrium, international borrowing, and also motivated by this wedge between domestic and interest and foreign interest rate. We're going to have that all firms are going to borrow up to their international collateral, because essentially being a cheaper source of finance, you have firms directly want to tap the international markets, but they're constrained by their amount of collateral. This is going to give rise to two kinds of firms in equilibrium. The firms that we call domestically unconstrained, that is firms with a high international collateral, lambda I, they can finance K star, and they have a slack domestic collateral constraint, right? That's on one hand. On the other hand, we're going to have domestically constrained firms with relatively low international collateral. These firms cannot finance K star. They need to borrow domestically, but they hit their constraint up to their pledgeable income, and of course they're gonna have a binding collateral constraint. The only price that is forming equilibrium is the domestic interest rate, and the market clear condition is very simple. We sum the demand from the constrained firms to the demand from the unconstrained firms, and we equal that to the total credit supply ET. And what governs the share of constrained and unconstrained firms is this endogenous lambda hat cutoff between the two. Okay, so as I mentioned, we try to keep things as simple as possible, but still we need some minimum structure on the credit supply side to talk about risk aversion amid the crisis, and also how this is affected by policies. We do that in the simplest way possible. We postulate that the total credit supply is the sum of the liquidity provided by the central bank, ECB, plus the liquidity, the endowment that households give. And what is going to determine the effectiveness of this liquidity of the central bank is going to be this parameter phi, which is going to capture risk aversion from shocks to capital market, that is movements in R star, exogenous movements in R star, but it's also going to be eventually impacted by changes in policies, which I'll say a few words later on. So to the extent that phi is greater than 1, then these excess reserves in banks are going to be accumulated because of this risk aversion that is triggered by COVID. So we're going to use this setup to do two quantitative experiments. On one hand, we're going to think about a COVID shock in a very simple way. We're going to think of a shock that impacts world capital markets and make EMEs riskier by increasing R star. On the other hand, we're going to consider the effect of policies, and we're going to, in this very simple model, we're going to assign FSIC type policies, these central bank credit facilities, to simply an injection of central bank liquidity, a delta ECB being greater than 0. Now, the FOGAPE COVID type of policies, we're gonna capture them through a simple relaxation of the domestic collateral constraint capturing theta D. So let me go step by step. Let's first focus on what happens with the COVID shock, and then I'm gonna switch to policies. I'm gonna look at the two policies separately and then joint. So first, the COVID shock without policies, just the COVID shock. Crucially, there's two channels going on here. A demand channel that begins by international collateral being more scarce, right? That's gonna constrain firms, all firms in the economy, equally. And then what that's going to trigger is firms, especially unconstrained firms, wanting to substitute away from foreign debt and into the domestic debt by borrowing more at home. This is going to drive the domestic interest rate up, and it's going to force constrained firms to borrow less, in addition to the fact that these constrained firms have less pledgeable output to begin with, given the shock. That's the demand channel. The supply channel is simply going to be a shift in the credit supply in this model, triggered by the risk aversion captured by this parameter phi. This is easily depicted in this graph. We have the domestic credit in the horizontal line and the domestic interest rate in the vertical axis. And what we have is, as COVID shock hits, then you have an increase in the demand for domestic funds that triggers an equilibrium, a new equilibrium for A to be had. But then there is the movement in the credit supply line, which increases the domestic interest rate even further from B hat to B. Now, what happens with policies? See, where are we in the new equilibrium once policies are implemented? Well, we're going to focus on the FSIC, again, the central bank liquidity type of intervention, where, however, that in the model, it's quite limited insofar as it is limited by the increase in the risk aversion in banks. So that makes that policy, if it stands alone, less effective. And liquidity will likely, in practice, only flow to the few large and safe firms. If you keep the central bank liquidity constant, but implement the FOGAPE COVID type of sovereign guarantees in the model, what you get is much more action. You get to unlock the credit supply by reducing risk aversion. This is captured in an ad hoc way in these parameters. So by increasing this theta D, this collateral, you relax the risk aversion in the credit supply side. However, if you do that too strongly, you can end up in an equilibrium where equilibrium interest rate actually increase because of all the boosting demand that occur. It's only when you apply to the model the two policies jointly, FSIC and FOGAPE, so credit bank liquidity and the sovereign guarantees, that you get a nice complementarity between the two, and eventually you get an equilibrium with much more credit at much lower interest rate, which is what we observe in equilibrium. So this basically postulates in a graphic way, in the same graph, what I mentioned. So before I had talked about this equilibrium shifting to B hat, and then by the increasing risk aversion moving to B. Now, if you implement the central bank credit facility, you do get some action, although limited, on the credit supply curve. It does increase credit, but not too much. Again, this in practice probably would have gone to the bigger and more creditworthy firms. If you do FOGAPE alone, which boosts this demand curve even further, you do get quite a bit of an increase in demand that potentially doesn't decrease rates as much as what we observe in practice. It's only when you combine both policies that you get an even bigger increase in the credit in equilibrium with a fall in interest rate akin to what we observe. Okay, so let me summarize the key takeaways. This is my last slide. So what we do in the paper is to show evidence of debt substitution by firms at the onset of COVID, with firms moving away from foreign and into domestic debt. We provide furthermore causal evidence that credit support policies, namely sovereign guarantees, may have fostered this debt substitution. And through the model, we underscore the role of financial friction in addressing this debt substitution, together with the complementarity between the two policies, again, the sovereign guarantees coupled with the central bank liquidity provision. Thank you very much.
Great. Thanks, Andrés. That was impeccable timing as well. I'm sorry to say that Benoit has not been able to join us. So we are one discussion short. I don't see questions yet in the chat, but I have a couple of comments. So I'll take the opportunity. So I think I like the strategy, the empirical strategy. I think it's very clean, it's simple, and it's very well summarized by this plot of the regression discontinuity, which is an empiricist dream come true, right? That's as clean as a result that you can get. So I think in that sense, the main question of the paper is very well answered by supported by the data, and the channels are very clear with the theoretical model. But I guess my question is that, as you well said, Andrés, there is also other things going on in the same period that, while I'm sure they don't affect the empirical result because it's well identified, it could perhaps be interesting to see whether you could advance a little bit in quantifying these forces. Okay, so let me name a few that I can think of. So I think that there are two main changes that occurred roughly at the same time as the COVID shock. The first one is that this is more perhaps in the recovery phase of the COVID shock. Especially in Chile, we had a huge fiscal response, right? Not only fiscal, but also liquidity, different liquidity measures like the withdrawal of pension savings. And this meant that the recovery that firms faced was mostly local driven. Many of the firms that perhaps are in your data also have significant businesses abroad. So for me, it would make sense that, given that most of the pickup is being felt in the local businesses, perhaps it also makes sense to, shift your funding sources in a local currency. So that might be one aspect that you may perhaps shed a bit of light with some additional empirical exercises. The other related aspect has to do with the exchange rate volatility, especially in Chile. So we throughout COVID we saw several stages, right? First, a very large depreciation of the peso. This was common in many emerging markets. Then we had the initial phase of recovery, and exchange rates went down. But then we have all this local risk going on, especially in Chile, with very high volatility of the exchange. So that probably also puts some incentives for firms to rely more on locally issued debt, to the extent that that the covering exchange rate risk is done only imperfectly through other means. So again, I don't think this issues invalidate at all the methodological approach that you guys are following, but maybe since you already have this data and these are issues related to what your main concern are, maybe it could be useful to see if in some additional exercises you could shed light on these issues.
Excellent. Thank you so much, Elias. Shall I react to that, or shall we?
There's another question by Carolina Villegas.
Mm-hmm. Okay.
So thanks a lot for the presentation and the very interesting paper. I mean, you have a fantastic data set. And you look at the mix of debt, but I was wondering whether actually debt went up or not. So it was only like a composition effect, or like the volume of debt went up. And if you know what were they doing with that debt, whether they were rolling over like or they were actually like investing or using like for like commercial paper, or what is it that they were doing with that debt, since you have all that information related. I don't know if you distinguish, but I guess like related with them the currency composition, like also like if you find like any difference with the maturity composition. I don't know if this is all like short term like that they have to give back. And then finally, like who was taking up? I mean, if you have like some characteristics other than size on leverage, on who is taking up this debt. I guess like look, I mean, moving forward, what would be like very interesting is to see like if exit or entry rates were affected by these policies. Thanks a lot.
Great, thank you, Carolina. Thanks a lot. Maybe Elias, I can react to this and see if there's more.
Sure, go ahead.
Okay, so no, thanks for these. These are excellent points. We've thought about a few of them, not all. In terms of the huge fiscal response, yes, this is clearly the elephant in the room. As you mentioned, Elias, there were a huge fiscal package that also appeared in the horizon in 2020. What we do is essentially rely on the timing, right? So I did not get a chance to say this, but the window of analysis goes to about August of 2020, right before the big fiscal policy package took effect, not only on the fiscal side but also on the pension withdrawals. So that is one way. It's similar to what we do in the other paper with you when we assess how firms adjusted on the real side. So that's pretty much what we can do so far. I have to say, however, that before these big packages that started to take place in August, September, August of 2020, these two policies that we analyzed, SIC and FOGAPE COVID, were really the first line of defense, right, for a few months. So on that, this allows us to get some sort of nice identification. And we don't want to go any further than August because of what you say. Exchange rate volatility. Yes, this is a huge topic that we're abstracting. At least as of now, we want to work much more on this. We have looked at some of the data on interest rates from these loans, and we've computed sort of like a distribution of what we call the ex-post UIP dollar rate, right? So that's just not to confuse the audience. This is what would be in terms of pesos, of Chilean pesos, what would you be paying for debt that was issued in dollars and that you didn't hedge through any means? So you have to pay the big depreciation cost that took place during those months. And we get some very, very big numbers because of the depreciation. So we conjecture that if you were issuing debt in these days and you saw these very big rates in dollars or linked to dollar debt, but in pesos, you would stay away from issuing dollar debt. It is a conjecture. We haven't tested. We would have the data to test it. But yeah, this is clearly an issue to explore. So the extent to which exchange rate considerations matter in the debt issuance. As of now, we can only say this conjecture. Now, on Carolina's very nice point, let me address a few. So so actually, you ask what are they doing with the funds, right, that they're issuing. in this project in particular, we haven't really asked that question. We have a separate, perhaps even more ambitious project that precisely looked at this, not in COVID, but because we have this nice merge between what firms are issuing in terms of debt abroad and the real side of firms. So we are able to document what is it that they're doing in terms of investment, labor decisions whenever changes in international capital markets occur. So we can bring this technology to this environment for sure. We haven't explored much about maturity. This is something worth looking at, and we would have the capability to do so. And that's it. We haven't explored much composition either. So this is also a great suggestion. I guess this is.
Can I add something, Andrés?
Sure, of course.
Okay, just I want to clarify a couple of things on this whole exchange rate issue and different currency debt, because it is important really to understand this cyclicality in this, right? Like, so dynamics of this, looking from both sides. So when we think about these episodes, we always think about the bad episode, right? The bust, the sudden stop, the depreciation, and we just say, okay, we can't borrow in dollars in an environment like that, right? Okay, but there's a lender side to this story. Lender doesn't want to lend you at that point in local currency, because that's a depreciating asset for the lender, right? So lender wants to lend you in dollars, and you want to borrow in local currency, but then it's an equivalent outcome. So when we think about debts, when we think about any debt contract, bonds, loans, you issue domestically, you issue externally, we have to remind ourselves it's an equilibrium outcome of a borrower and a lender. And that premium between the two is basically what the UIP premium is. And remember the figures I showed you yesterday, right? That's very cyclical with these indicators that picks up that risk premium, such as indicators such as VIX. In fact, it goes the other way around, right? I mean, during bad times when VIX is high, when you look at the equilibrium outcome, you see that share of foreign currency stuff goes up and local currency stuff goes down. Why? Because that's a lender dictated growth, right? So it is a little bit, kind of getting into this whole corporate finance. Corporate finance people think is always more from the lender discretion side, right? And macro people, we think from the borrower side. But again, going back to Mark's point, right? There is a reason why during these bad events, governments can only borrow short term. So we have to think the both sides. And that cyclicality, the fact that you always pay more on the local currency. First of all, that average fact is there. Remember the UIP premium I showed. It's always positive. It's always positive. It doesn't go to negative. Actually, there are going to be a few countries where it goes negative, and that Chile is going to be one of them. But basically, it's always positive means your interest rate you are paying on the short term there is way more than the expected depreciation. So expected depreciation is if it is too much, then that's going to make it negative, right? But there's huge interest rate differential on that, right? That's why it's always positive. So that's why investors always earn excess return with actual depreciation, and they expect to earn excess returns positive. It's always positive excess returns with expected depreciation. This doesn't happen in advanced countries. This is an emerging market thing, right? It never goes there. It's never negative. It's always on the positive side. That's the average. And then it fluctuates, right? It fluctuates because the share between local currency and foreign currency thing is going to move with these risk premium shocks. And the beginning of COVID is the mother of all risk premium shocks, right? That's why that figure Andrés showed. There is no reason for corporate spread suddenly skyrocket like that. If not, it's a risk premium shock, right? I mean, it's not that like overnight corporates are becoming more risky, right? So in that sense, I mean, so that cyclicality is going to be determined both sides. So and during those type of high uncertain moments, lender is going to prefer to lend you in dollars, even you want to borrow in local currency. It's a trade-off, right? The trade-off is yes, the default risk is higher on the foreign currency stuff on the borrower side. The valuation, but on the lender side, of course, it is a non-depreciating asset. So we have to always keep both sides, and that's exactly why this difference in the price is there even at a micro level. So it doesn't have to be that external. Even in a domestic lender, a domestic lender is going to charge a lower price on the foreign currency lending versus local currency lending, right? So it's all about that difference. That difference is always positive, but it becomes a big positive during hugely bad events, and it becomes a small positive during booms. So that's going to determine these shares of these different currency borrowings. So I think that's something very important.